Emergent properties and complex system dynamics, why this will be their undoing. Imagine the concept of something that is complicated, and then imagine the concept of something that is complex. These two things are not necessarily the same. A complicated system might be a fine Swiss watch. With enough practice and experience, the watchmaker can take the watch apart, look at all the small pieces, the complications that are therein, and then put it back together. That is a complicated system. But a complex system is inherently different. A complex system cannot necessarily be easily understood even if one had perfect information about the system. The reason this is the case is of another concept called emergent properties. Properties that only emerge once a system is underway. So again, going back to the watch example, imagine if you open the back of the watch and instead of there being a bunch of small gears, springs, cogs, etc., imagine instead it was just this pool of liquid metal that somehow worked together. Think like, Terminator, the T-1000, whatever from back, This is the point. The more interconnected something is, the more complex something is. Not necessarily complicated. It can be complicated, but when you add complexity to it, complexity is what opens the door to these emergent properties. And when you have emergent properties that come in, you have unforeseen consequences. Imagine you have a snowfall on a ski run or whatever, right? Snow falls and falls and falls, creating the risk for an avalanche. You don't necessarily know the exact snowflake that's going to fall on the snowpack in the correct manner, time, place, whatever, to actually start the avalanche. But you can make an argument, or you can at least reasonably foresee there will be a single snowflake that could theoretically start and kick this entire thing off. The prior two examples that immediately come to mind are 1998 when LTCM almost blew up due to Russia defaulting on their sovereign bonds. The second thing would be 2008, where you had a collateral crisis with mortgage-backed securities. And the thing that emerged in this particular situation was the snowflake started with collateral that people thought was pristine and could not be impaired. Suddenly was anything but. This immediately triggered this fallback where you had people that started to act irrationally. And the acting irrationality is the manifestation of these emergent properties and becomes very hard to, or if not impossible, to predict or try to figure out how to withstand. Short of just pulling all your chips off the table, even if it means selling at a loss and going defensive, cash, metals, whatever. So taking this all to GME, because let's be honest, that's probably why you're here. From the perspective of those who wish to go short or long on an equity, but short's probably but let's just focus on the short side of the equation for the time being. Sure, you can engage in these complex transactions. I love the term exotic transactions to describe this, but my point is that you have these complicated transactions that are intertwined with everyone else in order to manage one's position, presumably a short position if you're talking about any of the meme stocks. The catch is the more exotic and the more counterparties you draw into it, the more complex the system becomes. So it goes from being just complicated to complex. And when it becomes complex, then all of a sudden you have the concept of emergent properties coming in. This is why I think complexity, particularly the emergent properties arising from a complex system, will be their undoing, and their undoing being their inability to maintain their short position or their ability to maintain margin requirements that would otherwise allow them to keep the party going.
Yeah, so the obvious question is, okay, Justin, I understand this. There's a lot that's happening, and the way these guys continue to create their complex mechanisms and continuously expand their balance sheet to infinity and beyond is something we'll have to stop that. And just like in 2008 and in 1998, there was no real warning sign or no trigger that you could look to kind of predict.
Just a quick note. There was, but nobody was able to associate it in. The trigger was actually the meltdown in Asia, which created a cascade that took about, 9 months, Josh, and ultimately blew up Russia. The Russia defaulting on the bonds is what triggered the spreads to widen at LTCM. So this is your point. You can know it, or you might be aware of it, but you won't necessarily be able to connect the dots until it's too late. So the answer is you're right and wrong at the same time.
Well, this is how it is for every time. Everyone sees it as a black swan event, but if you are very diligently looking, you can see signs sparking. Same thing in 2008. There were people that started to see mortgages start to rise. They started to see their repos fail start to rise. They started to see all these signs. Today, the timing is what's important, though. Today, we see the same sorts of trickle-down effects start to come in. We see the yield curve just invert, which has a very high probability of a recession coming. Complex mechanisms do not perform well in times of recessions. Then we see repo fails start to spike. That is, you don't want to be a complex system when repo fails are spiking, just like they did in 2008. We're not quite at those levels, but we are similar to where we were in March of 2020. And you don't want to be comparing March of 2020, which was a very close collapse of a lot of toxic garbage if the Fed and government did not step in and fill liquidity when liquidity was desperately needed at the time. Eventually, they won't be able to fill a hole that is with a gap so big. But there are signs that we start to see that are building up, building more and more fragility into the system. And the more and more fragility that we see, the worse it is for complex mechanism. But the thing is, just like in 2008 and in 1998, everything was very slow. It seems all uncorrelated for a very long time until the catalyst arrives. And once the catalyst arrives, everything will shoot up and it will all make sense in hindsight. So trying to connect the dots from reverse repo or repo fail spiking to a short position is nearly impossible until it happens. So you are wrong until you are inevitably correct.
And I will also add one other thing too. I'm fond of this phrase. They will be able to kick the can far longer than you think they'll be able to kick the can.
I'm sure nobody in their right mind thought that it would go on as long as it did. If you're talking about a short position on certain stocks or anything. And just like Michael Burr, he was going short mortgage-backed securities back in like 2002, 2003, like 4 years before it really played out. But when he was inevitably right, of course, everybody looks to him now because he was correct that one time to see what he's seeing today.
Yeah. And the other caveat to what I said too is even if it takes longer to happen than you think it will take to happen, when it actually does happen, it'll happen far quicker than you think it can happen. So in other words, it's going to be slow, fast, over. Bam. There's that. There was another thing too. I was just finishing watching a video by Steve Van Meter, the Bond King. I'll put a link down below. But he made the concept about how VIX is spiking. And here's another dynamic that we haven't, or at least I don't think it's been talked a lot about in GME land, but I do think there'll be a tie-in to it. It's this, that if you have a bunch of ETFs that are flying on autopilot, they might, let's say, use the VIX as a metric for, safety. So in other words, if they say, well, listen, the VIX tops out, let's say, like, 3 higher highs, and this is just numbers on my backside, but if the VIX tops out at 3 higher highs within the period of, let's say, 6 months or so, that is the ETF on autopilot, is going to say we're going to take 20% of our risk off the table. So in other words, we're going to sell off a bunch of or we're going to sell off a material portion of the assets. By no means all the assets, but again, we just kind of want to take a step back and take some risk or whatever, right? But again, when you have the computers driving this, especially if they're looking back and they're looking back at volatility, and the volatility has been spiking a lot, this might be the very thing that creates more volatility in the system, because in the process of doing that, you get sell pressure that goes into the market, particularly if the FANGs are performing weak, and they have been performing weak. And all of a sudden that spikes VIX again, then you might have another algorithm that's just on the edge. This is the snowflake, for example, hitting the avalanche to create the thing starting down.
And that's why we see there's no such thing as like a 3 sigma move in the markets, because we go straight from a 3 sigma move all the way to a 6 sigma. And that just means there's something that's very improbable that happens, and it turns into something that is so catastrophically improbable because the way that dealers and market makers are positioned, that they're just meant to sell when everybody's selling, and it just creates these positive feedback loops of just massive chaotic volatility, which is where Chris Cole comes in, and we'll see these massive wild shifts of volatility where VIX will just get crushed because everybody is short volatility at the same time, which means everybody's long different types of stocks or derivative products. And then once the VIX gets to a certain level, everybody's short. Every inflow of money that they get, they buy. Every outflow that they get, they sell. They look at no fundamentals at all, which is why we see situations where instead of stocks driving the market, like individual stocks, when people buy stocks, therefore brings up the indices. When a lot of people buy a bunch of individual stocks, that's what we used to see. But now people buy ETFs, and the ETFs raise the price of everything, because when you buy an ETF, you buy a portion of every single stock. So we're seeing different things that are driving markets today. So when these pension funds and all these mutual funds, every inflow they get, they buy or sell an ETF. That when stocks go down, people sell. That is what the majority of people do. They sell, so they go to their ETFs and they sell, driving everything down with it.
Yeah. So would it be correct, like saying that, here's how I kind of envision it. It's almost like you've got a plane that's flying on autopilot. In other words, ETFs are basically just things on passive autopilot. The computer just does whatever the computer's going to do. And so this works great like 99% of the time or whatever, right? But the one time that you actually don't want the autopilot to fly is the one time that you've got something that's weird, that's outside, the normal rules. That's the 5 or 6 sigma event. Because if you have the autopilot flying in that particular situation, even though it can handle 99% of the problems fine or whatever, right? That 1%, that's the 1% where you're really going to be hosed. And so, yeah. So basically, sorry, Josh, let me put a bow on this. What I hear you saying is that we've conjured up, or we potentially have conjured up a passive demon in the market, where that you just have this automated thing, or from the automation standpoint, the algorithms will just do what the algorithms were going to do. But if you had a human intervening, it'd be like, whoa, 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 wait a minute, we're just going to hit the pause button, just
You know what that brings? Complexity.
Yeah, these are the emergent properties. This is an example of an emergent property. Oh, and just to tie it back into, the GME and other, shenanigans that are going on that front. Suppose, let's say that one of the ways you're able to maintain your margin position is that you don't have banks calling bullshit on other banks, or banks are continuing to or banks are refusing to impair collateral. That's probably the better way of thinking about what's going on here. But if you have something that starts in, let's say, passive ETF land or whatever, right? Something freaks out there, you might think about like a bank as being kind of like mom and dad in a sense, where like, one parent will be like, okay, listen, we have absolutely got to be cool when it comes to like not margin calling, our various hedge funds that we provide primary dealer brokerage services for. Because if we margin call them, we will blow them up. And when we blow them up, their blow up, it's gonna fall right back in our lap. So we don't want to do it. So this is where you have the system. We're not wanting to call bullshit on the other system, but this is again the complexity and the emergent property merging. You might have another division of the bank, completely oblivious to what's going on here, that says, hey, listen, we hit our risk tolerances for nothing compared to GME or meme stocks. It's some weird ass bonds or whatever, right? Something weird happens over in left field, and the bank. Because remember, like the left hand might not know what the right hand's doing at time. So you might have the one department say, listen, we cannot margin call our hedge funds. But you have another department that kind of does like a bank-wide margin call or changes something, which basically creates a de facto margin call in this other department or overrides the other department, which guess what? Blows up, the hedge fund, which which could theoretically blow up the hedge fund and then, blow back up. Again, this is the properties that are emerging as the system becomes more and more complex. For that. So anyways, there are two things I can immediately think of that will be their undoing. The first one we just talked about in the video, and that's, emergent properties from complex systems. The second one is what we already know, and that's Josh's selfishness, because Josh refuses to shave his head. I keep telling Josh, if he just agreed to shave his head if GME hit 150 again, this would be over before you could say, I don't know, boo. But anyways, Josh is very selfish, so be sure to give him a lot of hate in the comments and let you know how much he's disappointing.
I did a course and said once Justin can grow some luscious locks that I will consider shaving my head. So I would say Justin is more selfish than I in that regard. And oh, by the way, we are going to post our...
Okay, Josh, your turn.
By the way, guys, we are all our more socio psychological type videos, like the non-economic videos. We have a new channel for because just for analytics, and apparently people don't like those videos, so we'll just post them on another channel because we like to do them. So if you do enjoy those other style of videos, you guys can check it out here. And thank you, and we'll see you on the next one.
Take care, Josh.